All right. Hello, everybody. Welcome back to another episode of the Wealth Building for Dummies podcast. I'm your host, Kyle Demian, and I'm joined here with Renji Matthew. And today we're going to talk about basically part two of our last podcast, where we talked about how the Rockefellers have built their wealth. And we did talk about how, in as part of their phase of building wealth, they used life insurance as part of their family bank and their family trust that they had set up to make sure that they could build and secure their wealth and be able to pass it on for generations. So the key and the secret to them passing along the wealth was using life insurance, believe it or not. Right? And this may sound crazy if this is the first time you've ever heard of this, but the strategy of using life insurance to not only shelter your money from taxes, but also from market risk, from creditors, and from people that are ever going to come to sue you, and from the IRS. It's been a strategy that's been used by some of the wealthiest families in the world over like the last 100 or so years, right, Renji?
Yep.
For sure. And the Rockefellers aren't the only family that have used this, but they probably have been the most successful because they've been able to build wealth and then allowed it to pass down for generations beyond just John D. Rockefeller, which was the main person in that family that built generational wealth. So Reggie, if you want, go ahead and start us off. Um, is there anything else that you want to add, at least on the history of life insurance for wealth building purposes?
Yeah, so like we talked about, like you said, this is part two of going more in depth because we did mention on that podcast we'll try to do an episode just on it. So there are two main cash value life insurance options that most people choose. Back in the time of Rockefeller, it was more whole life option that was available. And some of you that are watching might have heard the option of infinite banking or be your own banker and stuff like that. Originally, it was done through a whole life policy, whole life cash value policy. This is a little different than your regular whole life. Most people have just heard of term life or whole life insurance. But now there's modern whole life and there's index universal life. The biggest difference between both is modern whole life, it pays out yearly as a dividend-based investing. It's similar to dividend-based investing when you buy a company stock or something and they pay you dividends every year. It's the same thing, but you're doing with mutual insurance companies, and depending on how that company does, they're paying you a percentage every year. Now, on the other hand, with an IUL, which wasn't around as long as the whole life cash value has been, but the biggest difference between the IUL and the whole life is with the IUL is index-based investing. So depending on whatever index you choose, and most common one is the S&P 500, but there's different options you can choose from. But depending on how that does in the market, that's how your growth is paid out to you. In both cases, it is inside the umbrella of insurance, so you don't get taxed if it's set up properly, and your money's protected because you're not actually in the market. You're mirroring what the market does in the IUL's case, so you're getting growth without having to worry about the downturns. So one of the options we talk about secure retirement accounts, and we talk about tax-free. This is what we talk about because it's secure, like we said, in the dividend-based option, you're not in the market, so it's just paying a dividend. You're not ever losing money. You're just growing it by a percentage. On the IUL side, it's based on the index, but because you're not actually in the index, you're not losing money when the market goes down because you have the floor, but you get to have the growth, but it's tax-free growth too. Now, I'm sure there's people that'll ask, Renji, how are you not losing when the market goes down? Well, let me use an example. Let's say you had 100,000 in the bank. What does a bank do with your money? They take your money, they lend it back out to you in the form of credit cards, mortgage, loans, whatever, right? But they also take money and put it into the market. But if they make money in the market or lose money in the market, it doesn't affect your money any. It's the same scenario that these insurance companies do, but one difference is they kind of partner with you. At least that's how I like to see it. they like to partner with you. So if they make money, they're kind of splitting that with you, right? So, but if they lose money, it doesn't affect you any because you have that floor. So that's kind of how that goes. Is there something you want to add, Kyle, before I show a little bit or talk a little bit more about the history?
No, no, you're continue on if you want to keep talking about the history, and then whenever you're ready, we can show like the side by side graph that we wanted to look at too.
Cool. Yeah. So if back in the day, let's just say before 2010, if you made more than $100,000, you couldn't put money into a Roth IRA. And things have changed since then. Even now, it depends on the state you're in and tax brackets you're in and stuff. But if you're making, depending on the state, around 150 or 200 or more as an individual, you can't put money into a Roth. Of course, there's loopholes you can use, especially if you own a business and stuff like that. But traditionally, there's you can't put money into a Roth if you make more than that much amount. So what rich people did before was they used LIRPs, which stands for Life Insurance Retirement Plans. Rich people don't need life insurance. They have all the money they need. They don't need life insurance. The only reason they use that is because of the tax codes that benefit you for using life insurance. Because if you look at anything out there, most anything that acquires money or gains money or grows money, you have to pay taxes on. But life insurance is the only thing. There's a couple tax code. The one that's most commonly used is 7702. But what it is under the umbrella of life insurance, the IRS, especially if it's set up correctly, the IRS can't tax your growth. So that's why the rich were using life insurance policies or LIRPs to stash money to grow it tax free. And now the reason that only rich people could afford it back then was because LIRPs cost way too much. But that's why insurance companies they decided there was like, hey, why don't we come up with something that the everyday people can use and it benefits everyone and we make more money too. So that's why they came out with the modern whole life and the index universal life. So that's a little bit of history of why these are around and all that stuff.
Yep, awesome. And then with that, just to kind of show you guys a side by side comparison so that we can look at it together. The left side shows the IULs and the pros and cons of an IUL, while the right side shows the pros and cons of whole life policies. So the IULs can have a higher rate of return. You have the ability to skip premium payments. You have more flexibility. Your cash value grows faster. There can be lower expenses, and you also can reduce the risk of outliving your money. Some of the downsides with the IUL is that you have to have an experienced agent. You have to work with somebody that knows what they're doing, how and why they work, and then most importantly, how to structure it for your greatest benefit. And then lastly, actually, that kind of goes hand in hand. It must be perfectly tailored to your family's needs, right? Some of the benefits of the whole life is that it's simple to understand. You have stable premiums. You can almost set it and forget it. And then it does have more guarantees than IULs. Some of the downsides or the cons with the whole life policies, though, is that it has slow cash value accumulation and it has more guarantees, which also will mean higher fees. So it's not to say that necessarily one is better than the other. It depends on your goals, right? How soon would you need the money? Do you not need the money at all? You just want to save for the future, or are you just looking for something that has death benefit protection to leave a tax-free legacy? Like those are some of the questions that you've got to start to think of, and or to let your advisor or agent know, so that this policy, this idea of becoming your own bank, infinite banking, or having an IUL whole life, so that this is best fit for you and what your goals and what your needs are, right? Because not everybody understands, as agents and advisors, not all advisors understand how to set these up properly. It takes some training, it takes some understanding to go through. And from there, once you know how to set it up and once you know that you have a trusted advisor, these IULs, these whole life policies can do great, great things for you. And like we talked about, tax-free growth, no market risk, more guarantees on your money. And then most importantly, the accessibility to be able to use your money and to access your money while you're alive for investments for, to buy a car, to send your kids to college, to buy an investment property. Like those are some of the uses that you can use for your money. And just to, let me stop the screen share. And I'm a big believer on definitions, right? And just to show you guys or to give you guys an idea of like infinite banking and becoming your own bank, what that means. The definition of infinite banking is a long-term financial strategy that involves overfunding your permanent life insurance policy so that you can use it as a line of credit. Okay, so you can use it as a line of credit so that you can go and borrow and take from. Very similar to becoming your own bank, right? Think about how do we traditionally borrow money to buy a car or to get a house? We've got to go to let's just say Bank of America and borrow money at a 7% rate. We get the $20,000 that we borrowed, and we have to make these payments or installments back to Bank of America. And let's say that they charge us a 7% rate of return. As we're paying back that money, as we're paying back those payments, Bank of America is keeping the 7% rate of return, and that's how Bank of America is making their money, right? If you had this $20,000 saved up inside of your own cash value life insurance policy, you could just go and borrow it from yourself and take it out. And what did you do? You just eliminated the middleman of Bank of America keeping that 7% interest rate. And now you're borrowing from yourself. You're borrowing from your own family bank, which is what the Rockefellers have done for the last 100 plus years. They don't go to Bank of America to access money for businesses or for investments. They go to their own family bank. You eliminated the middleman. You don't have any credit checks. There's no financial statements required. You don't have to pay it back in their set amount of time. Like Bank of America may require you to repay that back in 5 years. Like you could pay it all back in the cash value life insurance within a few years, or you don't ever have to pay it back. It's truly your money that you're accessing or you're using, right? And so that's what to define bank of, or becoming your own bank. To define that, it's basically like having your own pool of money that you can go and access yourself without credit checks, without financial statements, and that you can use at any time. Right. Renji, was there anything I missed there that you wanted to add on to those different concepts we just talked about?
No, I think that explains everything. I want to tie this a little bit to talking about investments into, like we talk about real estate or whatever passive income. The way this works, it kind of works just like an equity line of credit from your home or whatever, right? So you build up cash value just like in an equity line of credit. You build up the equity you have in the home because you've been paying monthly, right? And it's the same thing. You're paying into these cash value policies monthly, so you build up the equity. Now, instead of going to the bank, just like Kyle said, you're using your own money and funding yourself as a bank to yourself, being your own bank. So now, same example, kind of like what Kyle used. Like, let's say you have 100,000, and I'll kind of go over this and the difference between using this for retirement and a traditional 401k or an IRA. Let's say you have 100,000 in a 401k or an IRA. If you borrow 20,000 out of that, which you can borrow from your, if for those that didn't know, you could borrow from your 401k or an IRA. But let's say you borrow 20,000 out of there for whatever you have an emergency, or let's say you want to put a down payment on a house, investment property. Now you have to pay that back in a certain time, whatever you set with them when you borrowed it at a certain percentage and pay it back in a certain time. Just like you would with a bank. You set those expectations. They'll set it with you when you first borrow the 20,000 from a bank too. Same scenario. You have to pay that back in a certain time with the interest you agreed to them with. Now, let's say you pass away with the loans from a bank. It passes on to your next of kin. Unless it's a federal loan or something that can be forgiven, most loans will pass on to your next of kin. With a 401k or an IRA, when you borrow 20,000, if you don't pay that back and you pass away, your family gets the 80,000 that's left over minus taxes. Now, in the same scenario, let's say you had 100,000 in one of these cash value life insurance policies, either Whole Life or IUL, whatever it may be. Let's say when you borrow 20,000 out of that, it actually doesn't come out of the cash value. It comes out of the death benefit. So what that looks like, let's say you started with a $100,000 death benefit without any cash value. Now, let's say just to keep math simple, let's say over 10 years, you have 100,000 in cash value. And now, because you have 100,000 cash value and your original death benefit was 100, your total amount that would go to your family if something happens to you is 200,000, because it's the 100,000 cash value and the 100,000 death benefit. What you could borrow from is the 100,000 cash value. Because one of the questions I've gotten from a lot of people is like, wait, so I can get 100,000 in death benefit and start borrowing from it right away? No, that's not how it works. If that was the
Yeah.
way, everyone would do it. It's
Yeah.
how much cash value you have that you can borrow from. So in this scenario, after let's say 10 years, you have 100,000 in cash value and 100,000 in death benefit, or now it's 200,000 in death benefit, because it was the original 100,000 in death benefit plus the 100,000 cash value. Now, when you go to borrow 20,000 out of that cash value, it doesn't come out of the cash value. The cash value acts as if it was never touched. It's uninterrupted compounding interest. Now that 20,000 actually comes out of the death benefit. So now your death benefit looks like 180 instead of 200. So you can pay that back to bring it back up and keep repeating the same cycle, just like you would with a loan or something. But if you don't pay it back and something happens to you and you pass away, your family gets the 100,000 cash value, all tax free, and the death benefit, that 80,000. So altogether, they're getting 180,000, all tax free. So hopefully that explained it. I was trying to do a quick recap of how it works and trying to compare it to a loan from a bank or a 401k, and kind of how it works similar to an equity line of credit. Because in the same scenario, you take it out, go put it into a property. Now with the income you're making from the property, you pay that down. Now you can rinse and repeat, keep doing that until you want to stop.
Yeah, absolutely. And most people think, because the wealthy, we talked about, the Rockefellers and other wealthy families using this. Most people make the assumption that it's only for the wealthy. But Renji, if somebody were to ask you, does this work for me? Or is this a good fit for me? Is this just for the wealthy? What would you tell them?
No, it can be. Again, like Kyle said before, it depends on your goals, where you are in life. If you're in your 60s and trying to set something like this up, it might not make sense if you're only wanting to put in 100 or 200 bucks a month, because it's based off of life insurance. So just like a regular term or a whole life, the older you are, the cost is going to be. So if you're older, you want to have to put in more money into it, because the whole purpose is to overfund your policy. Because I think Kyle mentioned this earlier, some of the pros and cons is you have to have someone that knows what they're doing, setting it up right. Because 90% of the time, and we both review a lot of these policies for other people too, and more than 90% of the time, they're not set up correctly. And when I mean set up correctly, and a lot of times the agent just doesn't know they're doing it wrong because they were taught wrong. And a lot of times, though, they want to line their own pockets with commission, because the way the agent gets paid is off of how much you're paying for the cost of insurance. So depending on how much you're paying for the cost of insurance, that's how the agent gets paid. So let's say, for example, you're putting in 100 bucks a month. I'll use my son as an example. He's 5 now. He was 3 when we set one up for him. If I'm putting in 100 bucks, his cost might be $5. In that same scenario, since I'm over 30 years older than him, the cost might be closer to 20 bucks. Same scenario. If I'm setting this up for someone in their 60s, their cost might be 90 bucks. So see, your 100 bucks only goes so much the older you are. So same scenario with my son, $5 is going to the cost of insurance, 95 is going to the growth side. And with me, it might be closer to 20. I'm just making simple math. For me, it might be 20 bucks going to the cost of insurance and 80 going to the growth side. So when we say that most people set these up wrong, they're putting all 100 going to the cost. Pros and cons of that. Pros is you will have a high death benefit. Cons is it's not set up the right way, so there's no cash value growing. If you're doing this for a high death benefit, this is not the best. Neither of these are the best products for you. There's other life insurance products that will do a lot better if you want a higher death benefit. We only recommend it to people that want to do the cash value growth.
Yeah. And my philosophy around it, because a question I typically get a lot is like, well, what's the minimum amount that would be required for me to have like cash value be able to grow up so I can become my own bank? And the number one, I always say the more that you save now, the more that you have later, right? Which makes sense. But if you're looking at like a minimum basis, I usually recommend 10 times your age. So if you're 25, you should start off with at least 250 bucks a month. If you're between like 40 to 50, it's about like 15 times your age is what I would recommend. So if you're 40, 40 times 15, what is that? 600 a month? That would be about 600 a month. And if you're over 50, 50 and maybe in your 60s to even have a chance for it to make sense to be able to build up cash value accumulation, I would probably recommend about 20 times your age. So if you're 50, 20 times 50 would be $1,000 a month. And we have clients that are saving, one, two, five, 10, $15,000 a month, over $100,000 a year into accounts like this. And they're not doing it for the life insurance benefit. They're doing it for all the tax benefits, the liquidity to your money, the tax-free growth, the tax-free access, and then the tax-free death benefit that comes when you pass away is just an extra cherry on top of all the other benefits that you can get for your money when you're putting it into something like an IUL or a whole life. Another question I get a lot, Renji, I'll throw this one over to you, is does all life insurance policies do this? Or maybe if somebody has a policy through work, does that policy allow them to borrow from it and access it tax-free and everything like that?
Simple answer, no. And I'll kind of explain why. Most life insurance policies that you get from work are group policies. And with a group policy, those are going to be the cheapest insurance you're going to find. Out, you'll never find something cheaper than your work policy because what they do is it's a group policy. So what the insurance company is hoping is 90 to 95% of people that get it are healthy. They know that not every employee is going to be healthy. So they think about 10% or something might be the unhealthy. But because it's a group policy, they don't look at everyone's health. They just give everyone the same kind of coverage for the same kind of price. So that's why it's cheap, because the insurance company is making a lot of money because most of the people are healthy. Now, the problem with those is they don't build cash value. It's mostly just a term. But if you get sick and you can't work anymore, some companies will just drop you, so you don't have that insurance anymore. Let's say you get fired or you leave that job, it doesn't come with you either. So you'll have to get new coverage now. And that's why these policies, these cash value policies, they are yours, so you can take it wherever you go, and you can, like we talked about before. Sometimes it's flexible, so you could, let's say you have an emergency where you lose your job and you can't put money into it, because these are cash value insurance policies. You could take the cost of insurance out of your cash value. This is why these are different than regular term or whole life, because regular term or whole life, if you don't pay 1 month, some companies will let you go 2 months. They'll cancel the whole policy. But with these, if it's set up correctly, you have cash value in there. So if you have a family emergency or something comes up, they can take just the cost of insurance, not the whole amount, but just the cost of insurance out of the cash value, which is great. So as long as you have cash value in there, and in both cases, it's going to keep growing, because in one case you're getting dividends every year, in one case you're growing with the market. So it's going to keep growing as long as there's cash value in there. And if that's the case, these will last a long time. If you're overfunding it.
Absolutely. And with that, one more question or topic I kind of wanted to go over before I think we can wrap up.
Mm-hmm.
Um, we've already kind of talked about like why the wealthy use it, right? The tax shelters, the liquidity, access to the money, protected from creditors, protected from people that are ever going to potentially sue them. Now that is a state by state basis, but most states do have it protected. The last part I wanted to talk about is like why investors and entrepreneurs use it. And we may have mentioned it, but I think we should definitely take a second or two to go over it again if we did. But when you borrow your money and you take your money out of these accounts, your money still acts as if it's inside of the life insurance policy, and it still continues to grow and earn either the dividends or the interest. So if you're borrowing $20,000, you're taking it out of the IUL, and let's just say you put it into another asset like real estate, right? Name whatever asset you want, anything that's putting money back into your pocket, and you're having an ROI over here because you borrowed your money. You put the $20,000 into, maybe a single family home. You're earning money over here inside the home, but your money that you took out of the IUL acts as if you never touched it and is still eligible to continue earning interest. So now you have your same dollar bill working in two different locations at the same exact time. And that is the true power of infinite banking and becoming your own bank, is having the same dollar bill work in two locations at the exact same time. It's what the banks know. It's called the velocity of money. It's what the rich and the wealthy know. And it's why the majority of people use these types of accounts to store and save money so that they can use it in the future for different types of investments. Right? And Renji, do you have anything to add on that topic as we're talking about it?
No, yeah, you hit it right there. It's you're acting as your own bank, right? So you want your same money to, especially if you're an investor, you want your same money making double. And another added benefit too is if you own a business or anything like that, there's more tax benefits if you use it as a key man's insurance. That's something where if you, let's say you're the CFO or something, like if you weren't there, they would have a lot of trouble. So for that person, they could use as a key man's insurance. So as a business owner, if you're paying for the premiums, it's a write off for the business. Yes, that person would have to pay the taxes on it, or in this case, you're not paying taxes because it's already tax money that's going into it. But as a business owner, it's more of a write off because it looks like they're paying income into them for them to pay for a policy, right? So there's so many different tax benefits to all of these. And like Kyle and I mentioned before, you just have to know how to set it up right. You just have to know what your goals are. Why would you set one of these up? And if you're doing it, there's two different ways that we set these up for people for. One is they just want to have a more tax-free retirement. And the other way is they want to use these to buy passive cash flowing assets. And instead of going to the bank for a loan, and especially if your credit's horrible, it doesn't matter with these. You don't have to have good credit with these. With a bank, you do to have better loans and better interest rates. You need to kind of worry about your credit. With these cash value life insurance policies, they don't care what your credit is as long as you're paying your premiums and stuff like that. So there's different benefits of using these, and like we talked about before, these are some of the ways you use it as a tax-free retirement account that are secure because you're protected from the market and you're growing your money tax-free. I have been asked this question in the past. It's like, what if I cancel the policy in 50 years or whatever? Well, so there's one thing is that the reason we're using it inside of life insurance is because it protects you from the IRS taxing the money. Now, if you cancel the policy and there's significant growth in there, now it's taxable because it's not protected under the umbrella of insurance. So the best way to use it is to borrow from it, or like we mentioned before, you don't have to cancel it. You could use the money however you want. Now that you have cash value in there, the premiums are going to be paid, or the cost of insurance is paid from the cash value, and the growth you're going to have is going to be way more exponential than what the cost is if it's set up correctly. So just don't cancel it. Just use the money how you want to. It'd be better for you than to cancel it. Now you have to pay taxes on the growth.
Yeah. I always tell people too, this is definitely a long-term strategy, and it's life insurance, and we're all going to pass away one day, right? So when you pass away, you want this to be there. You want this to be enforced because whatever money is inside of the account, there's a higher death benefit that it's going to grow and blossom to, and it's going to pay out that higher death benefit to your loved ones, and it's all going to be tax-free. That'll probably be the only money that your family inherits tax-free, unless you do proper estate and financial planning for after your years through using trusts and stuff like that, which we've talked about. But life insurance is the only one that is automatically tax-free and avoids probate, avoids estate taxes. It truly goes directly to your beneficiary through the form of a tax-free check. So with that, Renji, anything else you want to wrap us up with?
No, I think we talked about it long enough. If you guys have any questions, you can always hit us up because we'll put our social medias on the bottom, and you guys can always hit us up, and we can review what you want to do.
Absolutely. Yeah, we're here to help. And thank you guys for tuning in to another episode of the Wealth Building for Dummies podcast. Remember, stop using Bank of America. Start using your own family bank. This is what the rich and the wealthy have done. If you want to see if this is something that makes sense for you, that's what we're here to do. Feel free to reach out to us on our TikToks, which we'll have linked below here, or even just put a comment on this video. We may be able to reach out to you through YouTube. I'm not 100% sure, but best way to probably reach us is through TikTok or our Instagram pages, which we'll have below. And until the next episode, thank you guys for tuning in. Hope you have a great rest of your day.